Did you see the headlines? Alibaba just dropped one of the most polarizing earnings reports of the year, where their core profit plunged 84% even as their AI and cloud growth rapidly accelerated. It's a massive contradiction that has Wall Street completely divided. Welcome back to MoneyJourney. I'm your host, and today we are diving deep into Alibaba's latest number to uncover the truth behind the noise. Is this aggressive drop in profitability a massive red flag, or is management planting the seeds for an explosive AI-driven future? We are going to dissect the earnings, look at the underlying fundamentals, and finally run the numbers to see if Baba's stock is the value play of a lifetime or a value trap. If you are serious about finding the best investment opportunities in the market and want institutional level stock analysis, make sure to hit that subscribe button to join the Money Journey channel right now. Let's get to work. Let's jump straight into the numbers because the surface level metrics are causing some serious whiplash. So looking at the top line and the e-commerce recovery, on the surface, total revenue was 243.4 billion renminbi, representing a modest 3% increase year over year. However, if you exclude revenue from disposed business like Sunart and InTime, the revenue on a like-for-like basis actually grew by 11%. The core retail engine is showing signs of life, with the Alibaba China e-commerce group revenue increasing by 6%. Not bad at all. Customer management revenue also saw positive momentum, growing 8% on a like-for-like basis. From what management of Alibaba said, I highlighted Alibaba's full-stack AI investments have progressed from incubation to commercialization at scale. They are already using AI. Cloud Intelligence Group external revenue growth accelerated to 40%, with AI-related products accounting for 30% of this revenue. This means 30% of cloud revenue is already from AI models. Our Qwen LLM demonstrated leadership in reasoning and coding, while we strengthen our multimodal portfolio. We see massive potential for agentic AI. This was the words of the CEO of Alibaba. They are believing these investments into cloud AI will strengthen their business and will high return for Alibaba shareholders. That's why they are investing. And that should be their priority number one if they believe in that. Then we heard from Toby Xu, CFO from Alibaba Group. Our strategic investment continued to translate into business growth. So they are seeing this investment in first sight increasing their revenue growth, and in the future you'll see profits from that. Cloud Intelligence Group revenue continued to accelerate, with AI-related product revenue achieving triple-digit growth for the 11th consecutive quarter. It was 11 quarters with cloud AI-related products growing above 100%. This is massive. That's why they are already 30% of cloud revenue. We are confident in our business outlook and will continue to invest in AI plus cloud to strengthen our competitive advantage. Bear in mind, Alibaba is the leader in cloud in China and now in AI. So they believe if they invest in that, creating massive cloud around that, they will increase their competitive advantage and maybe create a very big competitive advantage and very big moat in their business overall. Now we have the elephant in the room, the profitability problem. Here is where investors panicked. The company reported a loss from operation of 848 million renminbi. When we looked at adjusted EBITDA, it decreased by a staggering 84% year over year, down to 5.1 billion renminbi. Non-GAAP net income fell 100%, basically it's zero right now. Why the massive drop? Management made it clear that heavy investments in technology and quick commerce severely weighed on profitability. Now, the most important part of this report and what most of Alibaba investors were looking into it, the AI and cloud boom. This is where the story flips, because while profitability dropped, cloud computing was a massive bright spot, with revenue growing 38% driven by AI demand. Revenue from the Cloud Intelligence Group hit 41.6 billion renminbi. According to CEO Eddie Wu, Cloud Intelligence Group external revenue growth, which means revenue that come from outside Alibaba Group, accelerated to 40%. He also highlighted that AI-related products now account for 30% of this external revenue, which is already a massive part. To put that into perspective, AI revenue achieved triple-digit growth for the 11th consecutive quarter. And, unlike the core business, the cloud segment adjusted EBITDA actually increased by 57% to 3.8 billion renminbi. So that's very good growth. Their cloud business is already profitable with plenty of room to improvements in the future. They are heavily pushing their model as a service strategy, launching products like Qwen 3.6 Plus and deploying over 100,000 Zenu PPUs from their chip-designed subsidiary T-Head. Because of this aggressive investment cycle, net cash provided by operating activities fell to 9.4 billion renminbi. Free cash flow was actually negative for the quarter, coming in at a loss of 17.3 billion renminbi. But do not panic about liquidity. Alibaba is still sitting on an absolute fortress of a balance sheet, with a net cash position of 260 billion renminbi, which equates to roughly 37.8 billion US dollars. Rewarding shareholders is still on the table, as the board approved an annual regular cash dividend for fiscal year 2026 of 1.06 US dollars per ADS share, which is equal at the same of last year. Now, let me open my MoneyJourney stock analyze and let's dissect the fundamentals, quality and the exact valuation of Alibaba's stock right now. Let's start with Alibaba's fundamentals. Alibaba used to be one of the favorite stocks for value investors because valuation wise it was very cheap. Right now it's going into investment cycle, so their fundamentals doesn't look the best because they are not focused on profitability. They are investing for growth, so it's not the best fundamentals we usually see on Alibaba. Forward P of 14, earnings yield around 4%, but if you take into consideration next year earnings, it will be like a 6% yield. But at this valuation, if they focus on profitability, it is a 10 plus earnings yield for sure. Balance sheet, 50 billion in cash, gross margins going up. So looking at these graphs, revenues going up. That's really good. That's what we like to see year and every year. So in terms of profitability, it varies a lot. So in terms of growth, we are seeing top line growth for sure. Free cash flow per share or net income per share, it changes a lot. If you look to the margins, for example, gross margins are stable, growing, but bottom line, it's changing a lot. So some years like 2023 they had free cash flow margin of almost 20%, but last year free cash flow margin was 7%, and 2026 free cash flow margin I expect to be a zero or negative. It probably will be a year with negative free cash flow for Alibaba. But shares outstanding going down. Alibaba has been buying back a lot of stocks, and return on invested capital was going up while net income was going up, but now they are investing a lot in their business and their net income and free cash flow are going down, so returns on invested capital are going down because they are not trying to be profitable or manage their profitability to the best they can. So doing our quality scorecard, MoneyJourney checklist, I already mentioned that. They have been growing around 5% their revenues, but they have plenty of potential to grow. They are expecting to grow earnings per share from this bottom level around 30% per year, so very good growth expect. In terms of quality of their revenue, I will assume it will be recurring because cloud, AI models, other business like they will be pretty very much recurring, but their core business are like consumer demand, so it will be between them, but I expect them to get higher quality in the future. So they are process development and research and development. They invest a lot. They are always trying to get new business, new products, so they are very good on that. In terms of margins, they have pretty good margin when they try to be profitable. Gross margins now close to 40%. Profit margins around 13% at average, but they could increase their margin very easily with they're investing in more technology and their cloud business, which is higher margin than their core retail business. But even if you look only for their core retail business, they are more profitable than, for example, their peers like Amazon. So maintaining profit margins, that's a metric that we like to see. No, they are not maintaining profit margins. They are in a heavy investment cycle, so that's a no. They have better margin than competition. They have pricing power, especially now with cloud and these AI investments. In terms of debt structure, they could pay all their debt with the cash on hand. Rates of returns, not high returns on invested capital. We don't see when Alibaba is profitable or more mature, what will margins be. But if they get around 15% margin, their rate of return will be pretty good. It will be around 15% for sure. So, but for now, they are not very good. In terms of management and culture, I think they are very competitive. Stock was very cheap. They do plenty of buybacks. Now they are prioritizing their cash to invest in their AI and cloud business, which is good. I believe they could yield better returns than if they do buybacks. But they do a pretty good work in the last few years. In terms of moat, this is between a narrow and a wide moat. The moat is getting wider for sure, but for now, I do not believe it's a wide moat company. Their cloud business is for sure, but their e-commerce, they could go to JD, to Pinduoduo, to other. There are plenty of competition in this area, so I'll not believe they have a moat. They have a narrow moat, but not a wide. I prefer to be conservative in my analysis. So they've been growing free cash flow per share, and they're returning a lot of capital via dividends and buybacks. So an overall quality score 73.2. This is a very good, and margin of room to increase. We could see maybe an 80 in the future if they resume or if they have investment into AI and cloud, yield very good returns. So in terms of that, then we go with valuation. So since it's a Chinese company, I would say business risk is medium. It was low because they have a really good balance sheet and good product, but now they are investing a lot, so there are some risks. So with that, my base case will have a minimum discount rate of 15%. I prefer to have a margin of safety in my discount rate to assess, because it's a Chinese company. There are risks overall with this investment and to the business. So my base case, I will assume they are expected to grow about 10%, especially with cloud growth being a bigger part of Alibaba Group. But I'll be conservative, growing at 8%. In terms of free cash flow margins, 17, maybe a little too optimistic. I'll be conservative with the 15%. And the future PEs, their moat will be wide. It's one of the best companies on China. So 18 PE, since we already have a margin of safety on our discount rate. With this assumption, we came with a fair value of $164 per share. So this means consider the price today to be an expected annual return of 19% if these assumptions came into fruition. So with this, looking at our dashboard right now, trading at $134. I don't know what will be the price on the opening of the market. So my fair value is 164. I'm very conservative with a big margin of safety already implemented on my discount rate. So if your fair value is $200 or even $300, maybe that's the true value of Alibaba, but I prefer to be conservative. So I have a margin of safety around 18%. So high quality company, one of the best, but it's China and still an investment cycle, so they could improve their fundamentals. Maybe it will be a 80 quality score in the future. So with these assumptions, 19% expected return, and for me it's a buy. I will not buy this company at this price. It's one of my biggest positions in my portfolio, and it's a MoneyJourney score of 58.1 overall, which means it's a buy. If I didn't have Alibaba in my portfolio, I'll be happy to buy this company at this price, but I'll prefer to buy it under $100 as I have done in the past few years. So, what's the final verdict on Alibaba? We have a business navigating a massive transition. The news is noisy and the short-term profitability has taken a massive hit because they are pouring billions into AI and infrastructure, but fundamentals remain intact. Double-digit growth in cloud, explosive AI adoption, and a 37 billion net cash cushion to fund this pivot. The current valuation tells us that the broader market expects absolutely nothing from Alibaba moving forward, meaning the bar for them to beat expectation is sitting on the floor. I want to hear from you. Are you buying Alibaba at these valuation levels, or is the uncertainty in China and their spending cycle keeping you on the sidelines? Let me know in the comments below. If you got value out of today's deep dive, hit that like button and do not forget to subscribe to MoneyJourney channel for more elite stock analysis. See you in the next video.